Ashmore Investment Management, a long-time investor into India, joins us. Morning, Jan. Thank you very much for joining us. Well, notwithstanding the last 18 hours of equities improvement, generally equities and commodities have been suffering from serious losses. What's worrying the global financial markets so much, and do you think this downtrend has more legs?
I think there are two primary reasons for it. One is that the US equity market is really struggling to make gains. We are basically flat for the year, and growth as a whole has disappointed. And there are signs that the very strong inflows into American assets has now pushed the dollar up to a level where it's really beginning to adversely impact US growth. And I think that's an important backdrop. The other reason is, of course, that we've had a lot of volatility in the Chinese stock market. And I think a lot of people are drawing inferences from stock market volatility in China onto the growth outlook for China. Personally, I think those parallels are too exaggerated. I don't think Chinese growth is nearly as vulnerable to equity market volatility as the market seems to think. But at the moment, those two factors, I think, are weighing quite heavily on the outlook both for equities and commodities globally.
Okay. Jan, hi, good morning. So will this make the Fed postpone its rate hike timetable, you think?
Well, I think the Fed is actually a lot more sensitive to equity market valuations than many give them credit for. After all, this is a central bank that is basing its entire recovery strategy on reinflating asset prices. So I think soft equity market performance is definitely going to weigh on the Fed sentiment. Let's not forget that the very first predictions of Fed hikes came as early as 2012. We are now in 2015. We still haven't seen a Fed hike. I really think the Fed wants to hike interest rates, not because it wants to stamp out rampant domestic demand, but simply because it wants to put down a marker to show that it is making some nominal progress towards a very, very, very distant objective of monetary policy normalization. I think the latest data, the latest volatility in the stock markets will probably have shifted the Fed's intentions a little bit further out into the future, probably closer to December than to September, if I had to place a guess here.
Okay. Well, this is a question that we ask most emerging market experts, and I think it assumes a lot of importance now because India is not performing that well. What is your own pecking order amongst equity markets for the rest of the year?
My favorite equity market right now is the H-share market in China. It is trading with a 7 handle on 2016 forward PEs. That's less than half of the valuation of the US equity market. I also think that the A-share market is beginning to look interesting. It is now priced at lower valuations than US equities on 2016 forward price earnings basis. Of course, there is some volatility in the Chinese market, and I don't think it is wise to just go in and buy the index, so to speak. I think there are, however, an enormous range of companies in China. Many of them are excellent world-beating companies, and all of them have been treated in exactly the same way as a result of the very rapid surge up in prices and then the very rapid decline. So I think there are definitely value opportunities within the Chinese equity market index. I quite like the Indian equity market index as well. It's gone down a little bit on the back of the global negativity that we've seen. But I think the Indian growth story remains pretty solid. We've seen investments in India on the public sector side beginning to make progress. I expect that's going to lead to complementary investments in the private sector, and then that in turn will give rise to a gradual consumer-led recovery in the Indian economy. So we're really looking at a trajectory for the Indian economy which looks not only positive, but actually looks very sustainable far into the future. And that really is quite good news for equity holders.
That's good to hear, Jan, but the Nifty has been actually meandering between 8,000 and 8,600 for quite a bit. Will it break on the upside rather than the downside? what kind of a return are you expecting, say, over the next 12 months?
I think given where we are now and how negative sentiment is globally, I think there's potentially quite a lot of upside here on a 12-month basis. I think over the next 12 months, we'll certainly have the volatility in the Chinese equity market quite firmly resolved. I think China will have made a lot of progress in terms of entering into the SDR basket for the IMF. I think people will begin to again focus on Chinese reforms rather than short-term volatility. I think the Fed hike will be out of the way. I think that'll be bullish for credit markets and for EM in general. So I think the global backdrop is on a 12-month horizon. The global backdrop is going to be considerably more benign than it is now. And I think 12 months from now we will also be in the middle of a very strong bounce in private sector investment and the start of a quite serious upturn in consumption in China. So all of these factors, both the domestic business cycle within China and the external environment, should be very supportive for Chinese equities. So on a 12-month basis, I think the likelihood is that we break higher rather than lower.
Okay, so the likelihood of breaking higher rather than lower, that's an optimistic view. If you're betting on the economy returning, are you betting on stocks like L&T and banks in the Indian market?
Yes, I think we're looking here at a sustained cyclical upswing, started with investment and then giving rise to consumption. So I think we're still looking at more investment-oriented sectors that are likely to do well at this point in the cycle, then later on giving rise to better performance in consumer durables and as well as consumer cyclicals. But I think that comes a little bit later in the stage. So I really like selective exposure to certain financials and also to certain industrials and even certain parts of the construction sector, provided that you can filter out the companies that have balance sheet problems from those that don't. So it's more of an investment-intensive focus in terms of the sector allocation at this point, in my opinion.
Okay. You said financials, Jan. So some state-owned banks like Punjab National Bank reported what looked like slower growth in bad loans yesterday. Do you like any of these banks?
No, that's consistent with the sort of view I've had of state-owned banks, that there is improved governance in state-owned banks. They're being run on a more technical basis and with less political interference at senior level in the banks. And I think this is beginning to show up in improved balance sheet metrics. This is also helped, of course, by the pickup in the broader economy. So it's a combination of better management in these banks, but also a more benign economic backdrop. I think that's beginning to bear fruit. So that's pretty positive.
So are you buying any of them?
Yes.
Okay, so
which ones?
Which ones would they be?
I'm not really going to go into specific securities, but I hope you'll understand that it's not my money, it's our clients' money, and it would be a bit like telling you people what's in your current account.
Okay, all right, we'll let that be. What will be, let me put it this way, what will be the sectoral distribution of your incremental sector stock picks?
Well, I expect the economic performance to be primarily led by investment-related activities, initially from the government side, and then subsequently moving more into the private sector. So we're really looking at sectors that are exposed to the government investment program. This is, indirectly this is banks, and directly it is more construction, infrastructure, those types of sectors where I think the upside is going to come initially.
What are your expectations from the RBI in its credit policy next week?
I think the Reserve Bank is likely to stick to its current position and not change rates. I think the signal from the last meeting was quite clear. The RBI has front-run its easing. It took a chance early on in the business cycle to cut early. There was even some criticism of the RBI for doing that. but it was proven right to do it, and it has provided the supportive macroeconomic environment for the government to get on with the tough task of building consensus around its reform program. So the RBI has done what it should do. It is now over to the fiscal authorities, the government authorities, to begin to deliver on the investment side, to deliver further on the reform side, and then to let the economy respond. So I think the RBI is going to stay passive and not change its monetary policy.
All right. Finally, before we let you go, what kind of returns can we expect? Do you expect from the Indian markets, say, in 12 months or in 18 months?
Well, I think we have considerable upside. I think we'll probably have about 10% upside at least, based on my expectations for the Indian economy.
Okay. And finally, also, what's the in-house view at Ashmore on crude? We saw a slight improvement overnight.
Yeah, that's a good question. It's certainly a little bit lower than I had expected at this point. We have seen quite a lot of pullback in supply in many sectors, especially in the United States. But the truth is that in an environment that's as risk averse as the market feels right now, there is a bid for dollars because of risk aversion. The fears about global growth on account of the performance of the U.S. economy, and particularly fears about China's slowdown, which I really don't think are very well founded. But because of these fears are really driving the market, I wouldn't be surprised if the momentum to the downside for crude will continue a little further. But I don't think it has as much fundamental basis as people think, so we could also see a snapback. I think the range that we're in now, we're certainly towards the lower end of that range. Of course, this is quite positive for many, in fact, for the bulk of the world's economies that are oil importers, and it's also positive for India as an oil importer. So for now, you know, the Indian economy should enjoy, but I don't think there is a strong fundamental reason to believe that the prices should go a lot lower from here, in my opinion.
All right, Jan, we'll leave it at that. Thanks for joining us. That's an optimistic view coming in on the markets, which, by the way, has started to move up a bit. So the Sensex is now up 70 points, and the mid-cap index is up about more than 0.5%.